There is a line on your property tax bill that climbs every single year, and nobody on that bill is ever going to tell you there are 4 states with a legal way to stop it. If you own a home and you are 65 or older, or you are within a few years of it, this is you. For a household living on a fixed Social Security check and a pension that does not move, the property tax bill is the silent annual raise your budget never gets, and it can run thousands of dollars a year. AARP found that 55% of older adults cite high property taxes as a reason to relocate. Here is the part that should make you sit up. One Texas couple I will describe in a few minutes, a composite based on common cases, not a real couple, on a school district tax bill that froze the year they turned 65, ended up keeping $11,487 over the next 10 years that their neighbors down the street paid out in full. And the only difference between the two houses was one question asked at one office. Same street, same rising home values, same tax rates. One household asked, the other never knew there was a question to ask. Today I want to walk through 4 states that cut seniors' property tax bills and the 4 different mechanisms they use. Because if you do not know which mechanism your state uses, you cannot ask the right question at your county assessor's office. This video is for educational purposes only and is not tax or financial advice. Talk to a qualified professional before making any decision about your specific situation. My name is Eric, and this is Retirement Plan with Eric. Every week on this channel, I break down the tax rules, the retirement traps, and the strategies that nobody else is bothering to explain in plain English. If that is what you came here for, hit the subscribe button right now and turn on notifications, because the next video could be the one that puts thousands of dollars back in your pocket. And let me lock the frame before we start, so there is no confusion. I am telling you what to ask, not what to file. I am not here to walk you through a form. I am here to make sure you walk into your county assessor's office knowing exactly the right question, because the right question is the whole game. Here is what is coming. The 4 states, Florida, Texas, North Carolina, and Arizona, and the 4 genuinely different things they do. An exemption, an assessment growth cap, a tax amount freeze, an assessed value freeze, and a deferment that puts a lien on your house. By the end, you should be able to tell me which of these 4 would help one particular couple the most, and why. Stay with me, because the difference between 2 of these mechanisms is the difference between your tax bill never rising and your tax bill rising anyway, even after you thought you froze it. Let me set up the people first. Mary and Tom, 68 and 70, a paid-off home, combined Social Security plus a modest pension of around $60,000 a year. This is a composite based on common cases, not a real couple. They could be in any of these 4 states, and the point of the whole episode is that the right move for them depends entirely on which state they are sitting in and which problem they actually have. So here is your first loop, and I am going to hold it open until the very end. By the time we finish, I want you to be able to tell me which of these 4 states would help Mary and Tom most. Keep them in the back of your mind as we go. And one thing to carry through the entire video, because it matters more than any single number I am about to give you. Every state is different. Every county is different. Check yours. Let me start with Florida, because Florida stacks 3 different things on top of each other, and most people only know about one of them. The first is the standard homestead exemption. On your primary residence, the first $25,000 of assessed value comes off for all taxing authorities, and there is an additional $25,000 off the value between $50,000 and $75,000 for everything except school taxes. So now look at this, because here is the second thing, and this is the one that quietly does the heavy lifting over time. It is called Save Our Homes. Once you have your homestead established, the assessed value of your home cannot rise more than 3% a year, or the change in the Consumer Price Index, whichever is lower. That is not a discount on this year's bill. That is a cap on how fast the taxable value of your home is allowed to grow year after year for as long as you keep that homestead. In a hot market where homes around you are jumping 10 and 15% a year, that 3% ceiling is the difference between a bill you can plan around and a bill that runs away from you. And here is the third thing, the one built specifically for seniors. Florida law, under Statute 196.075, lets each county and city adopt an additional homestead exemption of up to $50,000 for homeowners 65 and older whose household income falls under an annually indexed limit. For the 2026 tax year, the Florida Department of Revenue puts that income limit at $38,686. That senior exemption only applies to the county or city taxes of the government that adopted it, not to school taxes. So what do you ask your county property appraiser? You ask whether your county or your city has actually adopted that senior additional exemption, because not all of them have, and you ask what this year's income limit is. And you ask one more thing. Has my assessment been growing at the capped Save Our Homes rate? Or is there a portability transfer pending from a prior Florida home? Because Florida lets you carry that accumulated cap benefit to a new Florida homestead. Now here is the part that changes everything. Because Texas does something Florida does not. Texas does not just slow down how fast your value grows. For seniors, Texas can freeze the actual dollar amount of your school tax bill. Stay with me, because this is the mechanism that paid Mary and Tom that $11,487 I mentioned at the top. Texas starts with a residence homestead exemption of $140,000 against school district taxes under Tax Code Section 11.13. Then, if you are 65 or older, you get an additional $60,000 off your school district taxable value on top of that. But the real prize is the third piece, the over 65 school district tax ceiling, sometimes called the tax freeze. In the year you turn 65, the dollar amount of your school district property tax gets frozen, and it cannot rise above that ceiling for as long as you live in that home, even if your home's value climbs, and even if the school district raises its rate. Let me put real numbers on that so you can feel the weight of it. Say Mary and Tom's home is worth $295,000 the year Tom turns 65. After the $200,000 in combined exemptions, they are taxed by the school district on $95,000, and at a school rate of $1.18 per hundred, that is a school tax of about $1,121. That number now freezes. 10 years later, their home is worth $472,000. Without the ceiling, that same school tax would have climbed to roughly $3,210 a year. With the ceiling, it stays at $1,121. Add up the gap, year by year, over those 10 years, and it comes to $11,487 they kept, and their unfrozen neighbors did not. So here is what to ask your central appraisal district. Is my over 65 tax ceiling already in place? What year was it set? And does that ceiling transfer if I move to a new homestead inside Texas? And hold this thought, because here is your second loop. Could Mary and Tom carry a Texas ceiling with them if they moved? Could a Florida Save Our Homes cap follow them across a state line? I will close that loop at the end, and the answer surprises almost everybody. If you are still with me, the next 90 seconds are the most important 90 seconds in this video, because this is the part where most people stop paying attention and start losing money. North Carolina. North Carolina runs two completely different programs for seniors, and confusing them can cost your children dearly. Listen carefully, because this is the sentence that costs people money. The first program is the homestead exclusion, also called the elderly or disabled exclusion under General Statute 105-277.1. It excludes from taxation the greater of $25,000 or 50% of your home's appraised value for homeowners 65 or older or permanently disabled whose income falls under an annually indexed limit. For the 2026 tax year, the North Carolina income limit is $38,800. So a qualifying senior in a home appraised at $200,000 would see $100,000, half the value, simply excluded from the taxable amount. That is real relief, and it is never paid back. But then there is the second program, and here is where the trap closes. North Carolina also offers the Property Tax Homestead Circuit Breaker under Statute 105-277.1b, and it is not an exclusion. The North Carolina Circuit Breaker is a deferment. The unpaid tax becomes a lien against your home. The deferred amount plus interest comes due when the home is sold, transferred, or the homeowner dies. This is not free money. It is a delay secured by your house. The circuit breaker caps your annual tax at 4 or 5% of your income, depending on where your income falls, and everything above that cap is deferred and piles up as a lien with interest. For someone determined to stay in the home for life with very little income, it can be the right tool. But if your heirs are counting on the house, that lien is waiting for them. So what do you ask your county tax assessor? You ask which program you qualify for under this year's income limit. And if you are even considering the circuit breaker, you ask the assessor to explain in writing exactly what the lien terms mean for your heirs before you sign anything. Now here is what makes the next one different. Arizona freezes a value too, like the Texas idea, but watch this closely because it is not the same freeze, and the difference is exactly the kind of thing that surprises an informed retiree. Arizona's Senior Property Valuation Protection Program, sometimes called the Senior Freeze, freezes the assessed value of your home. It does not freeze the dollar amount you pay. Let me say that again, because it is the whole point. If your county or your school district raises the rate, your Arizona tax bill can still go up, even with the freeze in place. This is different from the Texas ceiling, which freezes the dollar amount itself. In Arizona, you are locking the value the tax is calculated on, not the tax. To qualify, you must be 65 or older, have lived in the home as your primary residence for at least 2 years, and your household income, averaged over the prior 3 years, must fall under the annually indexed limit. For the 2026 cycle, that limit is $47,712 for a single owner and $59,640 for 2 or more owners. So picture an Arizona home with an assessed value of $250,000 when the freeze is granted. That $250,000 stays as the taxable base for the life of the freeze, but the actual dollars owed are that frozen value multiplied by whatever rate the taxing authorities set each year. So here is what to ask your county assessor. Does my county process these applications on an annual or a multi-year cycle? What is the current income limit? And what happens to the freeze if a co-owner dies or the home goes into a trust? So let me close the loops. Mary and Tom, the composite couple from the start. Which state helps them most? It depends entirely on the problem they actually have. If their worry is that rising home values keep dragging their assessment up, they want protection against assessment growth, which is Florida's Save Our Homes cap or Arizona's value freeze. If their worry is the dollar bill itself climbing no matter what, they want the Texas over 65 ceiling that locks the amount. And if their income is low enough to clear the limit, North Carolina's exclusion simply wipes out half the value with nothing to pay back. The right state is the one whose mechanism fixes the problem they actually have, not the one with the biggest headline. Now the second loop, on portability. Florida's Save Our Homes cap is transferable, but only within Florida. The Texas school district ceiling can transfer too, but only within Texas, and only as a percentage of the prior ceiling. The North Carolina and Arizona programs are tied to the specific home, and a cross-state move restarts the clock everywhere. There is no carrying a Florida cap into Texas, or a Texas ceiling into Arizona. The moment you cross a state line, you start over. Here is your action checklist, the questions to take to your county assessor or appraiser this week. 1. Do you offer a senior homestead exemption or exclusion, and what is the income limit this year? 2. Is there an assessment freeze or a tax amount freeze for residents over 65, and which one is it? Because as you just heard, Those are not the same thing. 3. Is there a circuit breaker program? And if so, does the deferment create a lien against my home? 4. What is the application deadline, and which form do I need? 5. If I move to a new homestead inside this state, do my benefits transfer? Write those 5 down because every one of them maps to something real I just walked you through. So one more time, simply. Same couple, same age, same paid-off house. In Texas, the over 65 school tax ceiling froze their school bill at about $1,121, while the unfrozen version of that same bill climbed past $3,200. And over 10 years, that gap added up to $11,487 kept instead of paid. That is not a trick, and it is not a loophole. It is the over 65 tax ceiling written into Texas law, and it has been sitting there in plain sight the entire time, waiting for somebody to walk into the appraisal district and ask. I have put together a free one-page guide that lays out all 4 of these states side by side, the 4 mechanisms and the exact questions to ask in each one, so you can carry it into your assessor's office and not forget a thing. It is completely free, no catch, and it is in the link in the description. It will save you the trouble of pausing and rewinding this video. And it might save you a great deal more than that. If this was useful, hit the like button right now. It takes 1 second, it costs you nothing, and it tells the algorithm to push this out to more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the notification bell, because I am walking the rest of the state property tax programs through this series. Florida, Texas, North Carolina, and Arizona were today's 4. Subscribe to catch the others. And if you know somebody who is 65 or older and owns a home in any of these 4 states, somebody who has never once walked into the assessor's office to ask, send them this video today. It might be the most useful 5 minutes you give them all year. Here is my question for you, and drop it in the comments. Which of these 4 states do you live in, and have you ever asked your assessor a single one of those 5 questions? I read every single comment, and the most common questions become future videos. I will see you in the next.